Does fear of loss keep you from investing in the stock market or from investing as much as you know you should in the stock market? We all know that stocks have a far greater potential than cash to truly grow our wealth, but so many are stuck in the slow lane of cash out of fear of losing it all. In this video, I'm going to share with you the time-tested strategies for reducing the risks of investing in the stock market so you can invest with confidence. It goes without saying, but I'm going to say it anyway. Never invest in something that you don't understand. Make yourself educated, like you're doing right now watching this video, and or seek the guidance of those who are knowledgeable and experienced in handling investments. One of the most fundamental strategies for reducing the risks of investing in the stock market is to diversify. And we've all heard so many times, don't put all your eggs in one basket. But I'm not simply talking about owning, say, 5 or 10 stocks instead of one stock. I'm talking about investing in many different stocks. Let's say, for example, you wanted to invest in large American corporations. You could invest in something like an index fund that's made up of large U.S. companies. Instead of owning 1 or 3 or 5 or 10, you can be invested in 500 or 1,000 or 3,000 different corporations. Now that's diversification. But we're not limited to just large U.S. stocks. There are mid-cap stocks, there are small-cap stocks, there are growth-style stocks, there are value stocks, and there are international or non-U.S. stocks. And if you would diversify within each of those different asset classes, your money's literally in thousands of places. How much less risky is that? This video goes into much greater detail on understanding the differences between these different markets or asset classes. Diversifying among all these different markets or asset classes is called asset allocation. So using asset allocation, you can diversify your stock holdings among these different markets. And then, in turn, within each of those asset classes, you can use diversification to spread out how many investments you have in each of those different asset classes. Some investors are not emotionally or financially suited to endure the significant short-term price fluctuations that even a beautifully diversified and allocated portfolio will exhibit. It's critical to the success of your investment portfolio that you understand your risk tolerance. How much fluctuation can you endure? How much of that are you willing to tolerate in exchange for higher rates of return? As financial advisors, we work with our clients to help them understand their risk tolerance and to make sure that we build a portfolio that is suitable for them. The next strategy, for those who are not emotionally or financially suited to having a portfolio made up 100% of stocks, is to introduce bonds into the equation. Earlier, we talked about how one stock was considerably riskier than having a diversified portfolio of stocks. The same thing can be said of bonds. One way to diversify amongst different bond markets is to invest in bonds that have different durations. There's another fancy term. It just means how long is the bond. Is it a 1-year bond, a 5-year bond, a 10-year bond, a 30-year bond? So if you have some short-term bonds, they are not going to behave the same way as intermediate-term bonds, which are not going to behave the same way as long-term bonds. The longer the term of the bonds, the more exposed they are to the ups or downs of interest rate shifts. And the way to reduce that risk is to have some money diversified among short-term, intermediate-term, long-term bonds, and to perhaps adjust those allocations as the interest rate environment changes. Just like with stocks, another way to diversify bond investments is to introduce non-American issuers. Governments or corporations that are not domiciled in the U.S. can also be in your bond portfolio. Yet another way to diversify your bond investments is to diversify amongst different credit qualities. You know how you and I as individuals have FICO scores based on our credit ratings? Well, bond issuers have credit ratings too. They're rated by companies like Moody's or Standard & Poor's. And just like individuals, a bond issuer can fall anywhere on the credit rating continuum from the highest credit scores to the lowest, from investment grade to high yield, also known as junk bonds. So the concept of asset allocation that we talked about with stocks also applies to bonds. And just like with stocks, a portfolio of bonds that has been allocated among many different markets and then in turn diversified within each of those markets is again at the opposite end of the risk spectrum compared to having your money invested in just one bond issuer. So for those who are not emotionally, financially suited to be 100% in stocks, a portfolio might include large cap growth stocks, large cap value stocks, mid cap growth stocks, mid cap value stocks, small cap growth stocks, small cap value stocks, international stocks, short-term bonds, intermediate-term bonds, long-term bonds, international bonds, investment-grade bonds, and high-yield bonds. Next, I want to talk to you about the importance of keeping a long-term perspective. Imagine you invest $500,000 into a house and the real estate market goes into a rough down period and you find that if you were to sell it, you would only get $400,000. Have you lost money? Only if you sold it while the value was down. On the other hand, if you waited and sold the house sometime in the future for $1 million, You didn't lose money when it went from 500 to 400. You did experience short-term price fluctuation. Same thing with the diversified portfolio investments like we're talking about. Now, as financial advisors, we work with a lot of pre-retires or retirees, and I often hear, well, I don't have the time to wait for the markets to come back, so I can't keep a long-term perspective. And I would ask you this, are you going to spend all your money the day you retire? Or is it for the rest of your life? Are you going to live another 10 years, 20 years, 30 years? If so, that's the time horizon I suggest you keep in mind. It all comes down to what you're investing for. Some of our clients tell us, I'll never spend this money in my lifetime. It's for future generations. That's their long-term perspective. Some investors try to time the markets. That means if they don't like the looks of things at the moment, they may exit the market with the intention of getting back into the market when they think things are better again. This requires an investor to pick the perfect time to get out and also the perfect time to get back in again. Over the years, there have been a number of studies done that have consistently shown that investors who try to time the markets underperform rather than outperform those who just stayed invested. In my 30 years as a financial advisor, I've never seen anyone successfully time the markets. Just say no to market timing. The next important strategy is to have an emergency fund. We talked about the importance of keeping a long-term perspective and how an investor isn't hurt when the markets are down unless they sell when the markets are down, and that's where the emergency fund comes in. If you've got cash on hand that you can go to should you need money, that can help you from having to sell your investments when the markets are down and realizing a loss. Even if you've implemented all these different strategies, you still want to rebalance your portfolio from time to time. I'm not talking about market timing. I'm talking about rebalancing the allocation of your portfolio as they take turns outperforming one another. If, for example, high-yield bonds had an above-average performance for a while, they could have grown to a bigger percentage of your portfolio, your pie, than you had intended in the beginning. You want to periodically rebalance it so that it remains true to your risk profile. If you're a do-it-yourselfer, I hope this helps you. If you're the kind of investor who likes help building and tending a portfolio over time, well, that's what we do. Reach out if we can help. For more on investing and retirement planning, watch these next.